While most headlines are busy chasing Hollywood drama and political squabbles, something way bigger just happened. China pulled the plug on U.S. tech heavyweights like Google, Apple, and Amazon. It's not just a random move, it's a bold, calculated strategy years in the making. These tech giants had been milking China's massive market for years, navigating tight rules just to stay in the game. But China's been watching closely, especially as the U.S. started using tech companies as tools in global politics. So instead of waiting around, Beijing built its own digital empire. Think Tencent, Alibaba, and homegrown cloud tech, setting the stage to go fully independent. This shift didn't come out of nowhere either. It picked up speed during the U.S.-China trade war under Trump, and now China's dual circulation plan is all about strengthening its local tech scene while shutting the door on outside giants. The truth is that China was once the world's leading manufacturer of goods. For decades, it was basically the go-to place for global manufacturing. From electronics to textiles to heavy machinery, you name it, China made it. At one point, it was responsible for nearly 30% of all global manufacturing output. That's wild when you think about it. But things have started shifting in a big way. Right now, the Chinese manufacturing industry is going through a serious rough patch. Some are even calling it a full-blown crisis. And it's not just about factories closing or exports dropping, it's a much bigger picture. This change could affect global business in a major way, including the prices we all pay for things like phones, clothes, and even furniture. Let's start with Apple. They're one of the biggest tech companies in the world, right? Well, even Apple has started to move production out of China. They've recently ramped up iPhone production in India, and it's not just a small move either. About 20% of all iPhones are now made in India, compared to barely 1% 2 decades ago. That's a $22 billion shift. Pretty huge. Why would a company like Apple do that? The short answer is, China's just not as attractive as it used to be for manufacturing. And one big reason for that is labor. Back in the day, China's workforce was massive and cheap, which made it a dream come true for companies wanting to cut costs. You could hire loads of workers for very little and get things made quickly and efficiently. But fast forward to now, and labor costs in China have skyrocketed. In 2005, the average monthly wage for a factory worker in China was around $150. By 2025, it's over $1,200. That's nearly a tenfold increase. And once labor costs go up, the appeal of producing in that country starts to fade. Compare that to countries like Vietnam or India, where the average monthly wages are still around $250 to $300. It's easy to see why companies are packing up and leaving. But wages aren't the only thing that's changed. Young people in China just aren't into factory jobs anymore. They'd rather work in tech or service industries, basically anything that pays more and feels more modern. That's created a mismatch. There are tons of factory jobs open, but not enough people willing to do them. So it's a labor shortage and rising wages at the same time. Not a good combo for manufacturers. The government knows this is a problem. That's why Chinese officials, including President Xi, have been pushing hard for more kids to get into manufacturing. They've even tried to control the narrative by cracking down on people who criticize the government. If you're too outspoken online, you could get blacklisted in their social credit system, which means no job, no house, no money. Basically, you're out of luck. But even though they've tried to fix it, the youth still aren't biting. Manufacturing just isn't seen as a desirable career path anymore. So companies like Samsung, for example, have already closed their last phone factory in China. They're done. And then there's the whole trade war between the US and China, which just keeps dragging on. What started back in 2018 with a few economic disagreements has snowballed into something way bigger. Now in 2025, the US is slapping tariffs as high as 245% on Chinese imports. That's not a typo, 245%. China's retaliated with its own tariffs, going up to 125% on American goods. This back and forth has created massive uncertainty. No one knows what's going to happen next, so companies are less willing to gamble on China. The tariffs are seriously jacking up the cost of doing business, and that extra cost doesn't just affect factories, it gets passed down to all of us. That's why your phone or laptop might feel a lot more expensive lately. Another huge moment that really shook things up was the COVID-19 pandemic. When it hit, China's strict zero-COVID policy meant factories were shut down completely for long periods of time, and that basically brought the global supply chain to a grinding halt. Since so much of the world's production was based in China, everything from electronics to clothing got delayed or became scarce. That woke a lot of companies up. They realized they were way too dependent on China for everything: raw materials, parts, manufacturing, shipping. So after COVID, many of them started looking for backup plans. And even though it's been a few years since the worst of the pandemic, China still hasn't fully recovered. All of this has caused a domino effect. First, companies started pulling out. Then China's own economy began to feel the hit. And finally, the rest of the world got dragged into it too. Let's look at it from 3 angles: global businesses, China's economy, and you, the everyday consumer. From a global business perspective, this has been a serious headache. Many companies had built their entire supply chains around China's capabilities. The country had great infrastructure, skilled workers, and a system that just worked. But with rising costs, political tension, and labor shortages, companies are now scrambling to set up shop elsewhere. Some are moving operations to places like Vietnam, India, or even Mexico. But it's not as easy as flipping a switch. Setting up a new factory takes time, money, and training. And not every country has the same level of infrastructure that China does. It took China decades to get this efficient. So building up that kind of capability in another country isn't something you can do overnight. That's why a lot of businesses are adopting what's called a China Plus One strategy. They keep some operations in China, but also invest in a second country. It's like having a backup plan in case things go sideways. This way, they're not putting all their eggs in one basket. Now, let's talk about China's own economy. The manufacturing sector was a huge part of China's rise on the global stage. It helped lift hundreds of millions of people out of poverty and created a booming middle class. But now, with factories closing and companies leaving, China is losing that economic engine. Unemployment among young people is high. Factories can't fill jobs, and the Chinese government is struggling to pivot to a new model. They're trying to push more tech, more innovation, and more services, but it's not easy to make that switch overnight. And last but not least, let's talk about you, the consumer. When manufacturing gets more expensive, so do the products. Those fancy phones, laptops, TVs, and even basic household items, they're all going to cost more because companies are trying to make up for those higher production costs. So, this manufacturing crisis, it's not just China's problem, it's everyone's problem. It's kind of wild when you think about how one country's internal challenges can ripple out across the entire globe. But that's the world we live in. Everything's connected. And China, once the world's most dependable manufacturing hub, is now becoming less and less central to that web. So what comes next? Well, countries like India, Vietnam, and Mexico are stepping up. They're trying to attract big companies by offering lower costs and better policies. But it's going to take time before they can fully replace what China once offered. In the meantime, expect some turbulence, higher prices, slower deliveries, and a lot of change in the way products are made and sold. Although China's manufacturing empire isn't gone completely, it's definitely no longer the unshakable giant it used to be. And that's forcing everyone, businesses, governments, and consumers, to rethink how things get made in the modern world. To really get a grip on how China used manufacturing to dominate the world, we've got to rewind a bit and see how this whole machine got rolling in the first place. From the moment China's manufacturing sector began booming, it wasn't just about churning out cheap goods, it was about building power. That economic muscle gave China the ability to stretch its influence far beyond its own borders. Take Africa, for instance. China didn't just pop in for a quick trade deal, it became the go-to development partner for a bunch of African nations. This wasn't random, it was a calculated move. China formed tight relationships across the continent, and in doing so, it raised its global profile significantly. There are 4 big reasons Africa became so important to China. First off, it's all about resources. China's economy is massive, and it needs energy to keep humming. That means oil and gas, and lots of it. These days, China actually imports more oil than any other country, even beating out the US. So to keep that oil flowing, China's been investing like crazy in African countries like Angola, Sudan, and Nigeria. These investments aren't just generous gifts, they're strategic. Sure, the host countries benefit, but China always makes sure it gets first dibs. And where's all that investment money coming from? Yep, manufacturing. It's the cash cow fueling this whole operation. Next, Africa's become a crucial market for Chinese goods. Manufacturing in China isn't as cheap as it used to be. Wages have gone up. So China's been looking for new places to send all those products. Africa's growing middle class has made it the perfect destination. This shift also lets China start pulling away from the labor-intensive stuff and lean more into higher-value manufacturing. There's also a political layer to all this. China values Africa's support on the international stage. In return for aid and investment, many African governments back Beijing's One China policy. For those unfamiliar, that policy means recognizing only one Chinese government, Beijing, not the island of Taiwan, which China views as a breakaway province. This support gives China extra weight in global negotiations. And once again, it's China's manufacturing power that gives it the money to build these alliances. Lastly, China has positioned itself as a stabilizing force in areas where it has major investments. But let's be real, it's not just because it wants to play world peacekeeper, it's about protecting its financial interests. That said, American governments benefit too. Unlike Western countries that often attach strings to their aid, like demanding political reforms, China skips the lectures. Its approach is business first, which appeals to governments tired of being micromanaged by the West. Now, critics have pointed out that this no-strings-attached model can lead to corruption, and there's definitely been some misuse of funds. But you can't ignore the fact that China's investments have helped transform infrastructure in a bunch of African countries. Roads, railways, ports, you name it. Manufacturing gave China this kind of global reach. It gave them the ability to loan billions to countries like Nigeria, Kenya, and South Africa. These countries, in turn, have aligned themselves with China's global agenda. As of 2025, African nations collectively owe China around $150 billion, mostly for infrastructure projects. That's a lot of influence, and all of it rooted in manufacturing wealth. But with all this power comes a dark side. China's rise hasn't been without controversy. Some people argue that it hasn't always used its influence wisely. Under President Xi Jinping, China has taken a more aggressive approach internationally. Its stance on Taiwan, for instance, has become even more assertive, and tensions in the South China Sea haven't helped. Combine that with its military buildup, and it's no surprise that other countries are nervous. There's concern that China might one day try to reclaim Taiwan by force, much like Russia did with Ukraine. Then there's BRICS, a group of major developing nations including Brazil, Russia, India, China, and South Africa. China is the economic engine of this group, and it's using that platform to challenge Western-led institutions. Whether this shift brings balance or chaos is still up in the air, but it's clear that China is trying to reshape global politics and economics. And again, it all traces back to the manufacturing sector that fueled China's climb to power. But here's the catch. China's manufacturing dominance isn't what it used to be. The industry is facing serious challenges, and if things continue to slide, China risks losing everything it built. All that global power, all those alliances, all the money and deals, it could collapse like a house of cards. That's why Xi Jinping is so concerned right now. He's trying to clean up the mess before it gets worse. And if China is losing its grip, the question becomes, who's stepping in to fill the void? Enter countries like Vietnam, India, and Mexico. These nations have been rising fast, and they're proving to be strong alternatives for global manufacturing. Vietnam in particular has become a hotspot for foreign investment. Electronics, apparel, you name it, companies are setting up shop there. As of March 31, 2025, Vietnam had pulled in nearly $11 billion in foreign investment, which is a huge jump from the year before. Why Vietnam? A bunch of reasons. Labor is cheap, the infrastructure is improving, and companies see it as a stable, reliable partner. Big players have already made their move. Danish toy giant Lego is building a $1.3 billion carbon-neutral factory in Vietnam. And not just any factory, this one's going to be fully powered by renewable energy by 2026. Thousands of jobs are being created, and it's a huge vote of confidence in Vietnam's future. And then there are the tech giants. Samsung has made Vietnam one of its biggest manufacturing bases, cranking out smartphones and home appliances. Intel's got a chip facility in Ho Chi Minh City. LG is producing all kinds of electronics there too. These companies are helping turn Vietnam into a tech manufacturing powerhouse. The apparel industry is another big win for Vietnam. Brands like Nike, Adidas, and H&M have been relying on Vietnamese factories for years. It's simply cheaper than China, and the quality's still high. Even furniture companies like IKEA and Ashley Furniture are investing in Vietnam as global demand continues to grow. What's more, Vietnam isn't just staying in the low-tech zone, it's attracting investment in high-tech sectors like electronics and semiconductors. Microsoft and Foxconn are both expanding operations there, showing that Vietnam has the talent and the potential to go beyond basic manufacturing. It's not just about being cheaper anymore, it's about being smarter and more adaptable. And right now, Vietnam is ticking all the boxes. India is also making big moves. It's positioning itself as a major player in manufacturing, and more companies are looking to shift from China to India. The country has a massive labor force, low wages, and a government that's been working hard to attract foreign investment. Take Apple, for instance. It started small, producing iPhones in Tamil Nadu, but now in 2025, Apple is manufacturing its latest models in India too. Foxconn, Apple's supplier, is investing billions in a new facility in Karnataka. This shows that Apple sees India as more than a backup, it's part of the long-term plan. Samsung's also gone all in. It runs one of the biggest mobile phone manufacturing plants in the world in Noida, cranking out millions of devices each year. This isn't a temporary setup. It's part of a big strategy to tap into India's skilled labor and booming consumer market. Dell and HP have joined the party too, moving parts of their production to India to take advantage of lower costs and friendlier regulations. This trend is only growing, especially as companies aim to diversify their supply chains and reduce dependency on China. India's government has been pushing high-tech manufacturing, especially in areas like semiconductors and electric vehicles. That's helped boost its image as a serious competitor in the global manufacturing game. So when you put it all together, what we're seeing isn't just a blip, it's a major shift. At the same time, technology is rewriting the rules. Automation is changing how factories work, letting companies do more with fewer people. Smart factories use real-time data to adjust operations and fix problems before they happen. It's not a futuristic dream, it's happening right now.